Last year, a 71-year-old retired teacher from Columbus, Ohio named Margaret walked into a bank on a Tuesday morning to withdraw $11,000 in cash. She had been saving that money for 2 years. It was going toward her granddaughter's wedding. Clean money, legal money, money she had earned, taxed, and saved over a lifetime of work. She handed her ID to the teller, asked for the withdrawal, and within 4 minutes she was sitting in a back office with a branch manager she had never met, being asked to explain where the money came from, what it was for, and whether anyone had told her to make this withdrawal. She was not accused of anything. Nobody called the police, but she sat in that office for over an hour while the bank reviewed her account. Her granddaughter's wedding money was eventually released, but Margaret drove home shaking. She told her daughter that night that she felt like a criminal for trying to spend her own savings. What happened to Margaret is happening to seniors across this country every single day in 2026. And the reason it keeps happening is not because seniors are doing anything wrong. It is because nobody ever sat them down and explained the 7 bank account moves that the IRS and federal agencies are watching for this year. I am Andre, and today that changes. By the time we finish, you are going to know exactly what triggers a federal report, exactly what your bank is legally forbidden from telling you, and exactly what to do right now to protect every dollar you have worked your entire life to save. But I need you to stay with me until number 6, because number 6 is the one that is destroying families quietly. And it almost always starts with an act of love. Now, before we get into any of this, I want to be very clear about something. Most of the people watching this video are not doing anything wrong. You are not hiding money. You are not avoiding taxes. You are just living your life, moving your savings, paying your bills, maybe helping a child or a grandchild, maybe selling something you own. Completely normal, completely legal activity. And that is exactly why this matters. Because the federal reporting system that is watching your bank account right now was not built to catch criminals alone. It was built to catch patterns. And ordinary seniors doing ordinary things with their own legal money trigger those patterns every single day without ever knowing it happened. That is what today is about. Not fear, information. Let us get into all 7 right now. Move number 1, and this is the one almost everybody has heard of, but almost nobody actually understands. The $10,000 cash rule. Under a law called the Bank Secrecy Act, which has been on the books since 1970, every bank and every credit union in this country is required to file a report anytime you deposit or withdraw more than $10,000 in cash in a single day. That report is called a currency transaction report, and it does not go to the IRS. It goes to a bureau inside the Treasury Department called the Financial Crimes Enforcement Network, FinCEN. Your bank files it automatically. You do not sign anything. You do not fill anything out. You will probably never know it happened. And here is the part that most people do not hear when they learn about this rule. The report itself is almost always completely harmless. It is routine paperwork. If you sell a car for $12,000 and walk that cash into your bank and deposit the whole thing, a report gets filed. And in the overwhelming majority of cases, absolutely nothing happens. Nobody calls you. Nobody knocks on your door. Nobody freezes your account. A currency transaction report is not an accusation. It is not an audit. It is a form that goes into a database and sits there. The danger is not the report. The danger is what people do the moment they find out the rule exists. And that is exactly what move number 2 is about. Move number 2 is the single most dangerous mistake a senior can make with their own clean legal money. And it has a name that most people have never heard. When people find out about the $10,000 rule for the first time, the instinct that almost everybody has is the same. They think, well, I would just keep my deposits under $10,000. I will bring in $9,500 today and $8,000 next week. I am not doing anything wrong. I am just being careful. That instinct will land you in federal court. What I just described is called structuring, and under federal law, Title 31 of the United States Code, Section 5324, structuring is a felony, not a fine, not a warning letter, a federal crime carrying up to 5 years in prison and fines up to $250,000. And here is the part that should make every single person watching this stop and really hear what I am saying. The money does not have to be dirty. You do not have to be hiding anything from anyone. Every single dollar can be clean, legally earned, legally inherited, legally gifted to you by your own children. None of that matters. If you deliberately break up deposits or withdrawals to stay under the $10,000 line, the act of trying to avoid the report is itself the crime. There are documented cases of widows, small business owners, and retired seniors who had their entire life savings seized by the federal government through a process called civil asset forfeiture, without ever being charged with a crime, simply because their deposits look like a deliberate pattern. The rule that protects you is simple, and I want you to remember it. Deposit your money all at once, every dollar of it, and keep a record of where it came from. A receipt, a bill of sale, a letter from whoever gave it to you. Never break it up to stay under a number, because the act of trying to stay under the number is the only thing that turns completely honest money into a federal case. Now, I want to stop here for just 1 second because I want to ask you something. Before today, did you know that breaking up your own legal deposits was a federal crime? Drop a yes or a no in the comments right now, because I have shared this information with hundreds of people, and I can tell you that the answer is almost always no. And every person who did not know was one unexpected withdrawal away from making that mistake without ever realizing it. Move number 3 is the report that has no dollar limit at all. And this one is the one your bank will never, ever mention to you. On top of the $10,000 currency transaction report, there's a second type of report called a suspicious activity report. And unlike the first one, this one has no minimum amount. A bank can file a suspicious activity report on a transaction of $500, $200, any amount at all, if the activity looks unusual compared to your normal pattern. And here's the part that makes this one particularly unsettling. Under federal law, it is a crime for any bank employee to tell you that a suspicious activity report has been filed on your account. They cannot warn you. They cannot hint at it. If you ask directly, they are legally required to say nothing. So you could be flagged this week, right now, based on something you did last Tuesday, and you will have absolutely no way of knowing. What triggers it is not the size of the money. It is a sudden change in your normal behavior. If you have been withdrawing $400 a week for 10 years and you suddenly take out $7,000 to pay a contractor, the system flags the deviation. It does not know you are fixing your roof. It does not care. It flags anything that looks different from your established history. The way you protect yourself is simple. Anytime you are making a large or unusual transaction, walk in with the paperwork that explains it. A contractor invoice, a sale receipt, a letter from your attorney. Hand it to the teller before they ask. That one habit turns a potential flag into a routine transaction, and the report never gets filed. Move number 4, and this is the one that happened to Margaret at the beginning of this video, the senior account freeze. In recent years, banks and brokerages across this country have been given expanded authority to put a temporary hold on the account of any customer 65 or older the moment they suspect that customer may be experiencing financial exploitation or elder fraud. The hold can last up to 15 business days. It can be extended beyond that if the bank believes there is cause. This rule was written with genuinely good intentions. Elder financial abuse is a real and serious problem, and stopping a scammer from draining a senior's savings is a worthy goal. But the same rule means that a completely clear-headed, fully competent retiree who walks into their bank to withdraw $20,000 to help a child with a down payment, or to pay cash for a car, or to move money into a higher interest account can be pulled into a back office, questioned about the purpose of the withdrawal, asked whether anyone instructed them to make it, and made to wait days before their own money is released. There is nothing about being sharp and independent that automatically stops the freeze from being triggered. The transaction amount and your age are enough. The way you prevent this from happening to you is to call your bank before the large transaction, not during it and not after it. Let them note on your account that you are planning a specific large withdrawal and why. Name a trusted contact person the bank is allowed to reach if they have questions. That one step, one phone call before you walk in turns a potential 15-day freeze into a 5-minute conversation at the counter. Move number 5, and this one is about protection, not punishment, but it is one of the most overlooked risks sitting in senior bank accounts right now, the FDIC insurance limit. Every account at every bank in this country is insured by the Federal Deposit Insurance Corporation, but only up to $250,000 per depositor, per bank, per ownership category. If you have $300,000 sitting in a single savings account at a single bank and that bank fails, $50,000 of your money is not insured, and you can lose it permanently. People assume bank failures are ancient history. In 2023, this country experienced 3 of the largest bank failures it had ever seen, all within about 10 weeks of each other. The depositors who were under the $250,000 limit were fully protected. Anyone above it was at risk. If you are holding more than $250,000 at one institution, the fix is straightforward. Spread it across more than one bank or across different ownership categories at the same bank. It costs you nothing. It takes one conversation, and it removes the risk entirely. Move number 6, and I told you at the beginning that this is the one that quietly destroys families, and it almost always starts with an act of love. At some point, someone tells a widow or a widower that the easiest thing to do is add one of the children to the bank account so they can help with the bills. so the money passes to them easily when the time comes. It sounds simple. It sounds responsible. It is one of the most financially dangerous things you can do with your savings. The moment you add your son or your daughter as a joint owner of your account, that money is legally half theirs, which means if that child goes through a divorce, your account can be pulled into the divorce proceedings. If that child is sued or has a serious car accident or owes back taxes to the IRS or files for bankruptcy, a creditor can legally come after the money sitting in your account because your child is a legal owner of it. Any one of the joint owners can walk into that bank tomorrow and withdraw every single dollar without asking anyone's permission. And when you pass away, that account goes entirely to the surviving joint owner, regardless of what your will says. It can quietly override years of careful estate planning in an instant. The thing that was supposed to make life simpler ends up handing your savings to a lawsuit, a divorce settlement, or one child instead of all of them. And there's nothing anyone can do about it after the fact. Move number 7 is the fix. And I promise you at the start that this one takes about 10 minutes. Instead of adding a child as a joint owner, you walk into your bank and you ask for something called a payable on death designation, a POD. Here is exactly what it does. You remain the sole owner of your account for the rest of your life. Your children have zero access and zero ownership while you are alive. No creditor of theirs can touch it. No divorce proceeding can reach it. No lawsuit gets anywhere near it. But the moment you pass away, the account transfers directly and immediately to whoever you named, without going through probate, without a court, without a lawyer, without waiting months for an estate to settle. It does everything people think a joint account does, with none of the danger. It is free to set up. It takes one short conversation at your branch, and it is available at every bank and every credit union in this country right now. While you are having that conversation, ask your bank one more question. Ask them to confirm that every dollar you have on deposit is within the $250,000 FDIC insurance limit. If it is not, ask them how to restructure it so that it is. Those two questions, the POD designation and the insurance confirmation, in one 10-minute conversation at your branch, protect more of what you have built than almost anything else you can do this week. Now, here's what I want you to take away from everything we covered today. The $10,000 report is routine and harmless on its own. Structuring to avoid that report is a federal felony, even with clean money. The suspicious activity report can be filed on any amount, and your bank cannot tell you it happened. The senior account freeze can lock your own money for 15 business days if you do not call ahead. The FDIC only protects you up to $250,000 per bank. Adding a child as a joint owner puts your savings at legal risk from their life. And a payable on death designation fixes the joint account problem for free in 10 minutes. None of this comes looking for you. Your bank does not call to lower your risk. The government does not write to explain how to protect your money. The system stays exactly where it is until the day you decide to move first. You now know what the 7 moves are. You know which ones to avoid, and you know the one conversation that protects everything. So here's what I want you to do this week. Call your bank. Ask about the POD designation on your accounts. Confirm your FDIC coverage. And if you have already added a child as a joint owner, talk to an estate attorney about whether restructuring makes sense for your situation. And then come back here and tell me in the comments which one of these 7 you had no idea about before today. Because I read every comment, and your story might be the thing that pushes someone else watching this to finally make that call. If this video helped you today, share it with one person you know who is over 65. Because the odds are very good that at least one of these 7 things is quietly putting their money at risk right now. Hit subscribe because this is what we do here every single week. I am Andre, and I will see you in the next one.